Hey, this is Leo. So today's video, we're going to talk about the DTC Collateral being waived, and then we're going to get into the fair value of AMC. I'm going to try to do a comparative analysis with Cinemark Holdings, and then we're going to do a historical, historical analysis to come up with a sort of fair value. Now, before we get into it, I want to say that this is the fair value. This has nothing to do with the squeeze. This has to do with where could the price settle after the squeeze were to occur. It has no merit on how high I think the squeeze will go. This is purely based on fundamental value of the company. So without further ado, let's go ahead and dive in. The DTC, they come out with this report talking about how they waived collateral essentially. And what's just frustrating about this is it just reveals the level of corruption and collusion going on behind the scenes. And essentially what happened is the Depository Trust and Clearing Corporation waived $9.7 billion of collateral deposits on January 28th, 2021. It's essentially what they're saying is, we know that you're really over leveraged on these positions. We're going to go ahead and waive that. We're going to go ahead and take on a little bit more of that risk ourselves. And I know why they did it. The reason they did the $9.7 billion waive of collateral is that if, let's say the squeeze were to have happened and the DTC were to be on the hook here and kind of default along with the Robinhood and the other market makers, well, they split the cost, right? So as soon as Robinhood and these market makers end up going completely bankrupt, who's on the hook? Well, it'll be the rest of the DTCC members, so Wells Fargo, all the other prime brokers, JP Morgan Chase. And so it makes sense that they would sit there and collude and waive $9.7 billion from their perspective. To me, it's wrong, it's corrupt, and it just spells disaster long term. So let's go ahead and dive into the fair market comparison. We're going to first look at Cinemark. So right here. So just going over a couple of things, you can see Cinemark's currently trading at $14.81 with a market cap of $1.7 billion. The revenue is $460 million a year. They have about half as many theaters as AMC. So you can just, throughout this analysis, keep in mind that Cinemark is about half the size of AMC, but their revenue is about 60% of AMC's revenue. So given that, well, I suppose first I want to say that this is assuming that Cinemark is currently at fair value, so keep that in mind as well. But with half as many theaters, so Cinemark has 520 theaters versus AMC's 950, 60% of the revenue of AMC, so they have $460 million in revenue versus AMC's revenue of $785 million. Now the market cap for Cinemark's $1.78 billion. So given that AMC is half that size, Cinemark is half the size of AMC, roughly speaking, if you take 1.78 and times that by 2, you end up coming with a 3.56 billion market cap for AMC. So if we divide, let me see here, 356 billion. I hate it whenever they don't put commas on this. I'm just going to do this on my phone. It's easier for me. One second. Okay, so we take the 3.56 billion and then we divide that by the current AMC outstanding shares of 516 million. You come up with a share price of $6.91. Now, if we take a look at the comparison analysis, so let's take a look at AMC's history. Looking at in the past here, where was AMC's best performing period? Well, it was back in 2015, 2016, with the AMC outstanding shares of 55 million. AMC was trading at a price between, we'll say, $23 to $27, $28 on the high end. Now, what has happened since then? Well, if we come over here, we look at the AMC historical shares outstanding, you could see how these shares used to be around 55 million, and then in 2021, Adam Aron had increased those shares to 450 million, and then later on to 516 million shares, where we currently stand. So what is going on there? Well, that is a share dilution. Now, what does that mean? Well, you're diluting the value of your stock by increasing the amount of shares, because it's, companies use this to raise capital, et cetera, but ultimately it decreases the value of the per share price. So let's say that you have a company, it's worth $100 million, and you have one share. Well, let's say that you print another share for that company. So now there's 2 shares in circulation. Did your company value just double to 200 million? All you've done is print a share. That doesn't actually create company value. It's not that it does the opposite. It dilutes the share price. So now with a company value of 100 million, and you have 2 shares, that means that each share is worth $50 million. So if we come over here and we take a look at AMC, what happened was during its best performing period, where it was around $27 and 55 million shares outstanding, later on, several years, Adam Aron increases the current outstanding shares to 516 million, right? So he diluted the share price. So what I'm going to do here is I'm going to take the best performing period when there was 55 million shares, and we're going to divide that by the current outstanding shares to come up with a potential share price. All right, so I'm going to take the 516 million current shares divided by the prior best performing period of, I'm going to go on the high end here. Let's say 27, right? Excuse me, I misspoke. I'm going to take the current outstanding shares divided by the prior outstanding shares to determine how much he diluted the share value by. So 516 million divided by 55 million gets you a factor of 9.38. Okay, so now we know that the stock per share value was diluted by 9.38. We would take the $27, divide that by 9.38, which comes up with now this doesn't count any growth that has happened since then. So if you count the additional revenue streams with popcorn and etc. that Adam Aron has added, the fair value is likely higher than this. But doing this calculation, it comes up to around $3. I would say that fair value, because doing the comparison analysis was showing 7, I would say that fair value for AMC is between $5 and $7. Again, this has nothing to do with the squeeze. This is purely based on fair company value, based on fundamentals, based on we're doing comparison of its historically when it was performing the best, and then comparing that to the shares that have diluted down the per share price, and looking at their competition to see what their competition is valued at. So it doesn't mean that the stock is going to, that it doesn't mean that it's not going to squeeze. It doesn't have anything to do with squeeze targets. But I had a lot of people that were commenting, and they were saying, why am I saying it's undervalued? They think it's a $30 stock. And I think a lot of that confusion is coming from back in 2016, where the company was valued around $30. But what they're not realizing is that Adam Aron had diluted the share value by increasing it from 55 million to 500 million. That's essentially why it has such a low valuation. If he never did this share dilution, absolutely, I'd be saying fair value's up here around $25, $27. But it was because of his share dilution that brings the value per share down so much more. So anyway, let me know your thoughts and comments down below, and I'll talk to you on the next one. Take care.